All right, hello everyone. Welcome to our March Mortgage Quality and Compliance Committee webinar. We really appreciate you tuning in and joining us this morning. My name is Samantha Gallagher. I'm the Member Engagement Director here at the California MBA. If you haven't joined us previously, we host these webinars on a monthly basis. They're typically on the fourth Thursday of every month at 11 a.m. Pacific time. And we highlight a wide variety of compliance and quality assurance topics for the residential lending industry. If you're a member of the California MBA and you'd like to be a part of our committee that helps decide the different topics and speakers that we focus on each month, please feel free to reach out to me and we can get you involved in the committee moving forward. And with that, I'd like to introduce our 2023 MQAC committee leadership. We have Michael Steer with MQMR as the chair of our committee, and then Melissa Kopel with Loan Depot as the vice chair. So with that, I'll turn over to you, Michael.
Thanks, Sam. So just want to welcome everybody to this month's MQAC webinar. My name is Mike Steer, and I'm honored to serve as the MQAC chair this year, along with our vice chair, Melissa Kopel. So we got a full year of awesome webinars in store related to key industry audit risk and compliance and quality control topics. One of those is today. Before we get started, just want to remind everyone, we have an opening for a sponsorship. So as a sponsor, you'll have all eyes on you for a 30-second commercial to talk about your company on each of our webinars, in addition to having your logo, just like this slide here, on all of our presentations and marketing communication. So if you're interested, reach out to me, reach out to Melissa, reach out to Susan Milazzo or Sam Gallagher. Last month's topic, we covered limited English proficiency and the supplemental consumer information form. Check out the California MBA website for the recording or reach out for a copy. It was extremely informative and very well attended. Now, today's topic is about optimizing loan quality and navigating the next wave of buybacks, which is a very relevant topic since the MBA just published a report that the cost to originate a loan spiked to $12,800 and IMBs lost $2,800 per loan during the fourth quarter. Now, we have two amazing speakers, one of whom I had the pleasure of speaking on a panel at a conference recently, James Brody, and the other whom I get to work with every day is Scott Weintraub. Now, these two gentlemen need their own presentation to cover all of their experience and knowledge related to compliance, repurchases, loan quality, but I'll try to keep it short and sweet. So Scott Weintraub, Vice President of Compliance at MQMR, he brings over 20 years of experience in the mortgage origination and servicing industry, focusing on legal and regulatory compliance, change implementation, and organizational risk management. As the VP of Compliance, Scott tracks and monitors news and updated laws, regulations, agency guidelines, and makes sure that MQMR and its clients are proactively aware of changes and ready to implement whatever steps are needed to remain in compliance. He also provides monthly compliance assistance to mortgage servicers and fair lending assistance to lenders and servicers. Prior to joining MQMR, he served as the Chief Compliance Officer for several large mortgage lenders in both retail and wholesale channels. He's also created and implemented compliance management systems, policies and procedures, audit protocols and training programs, an enterprise risk management framework, and internal audit, just to name a few. He holds a bachelor's degree in political science from Stanford University, Nerd Nation as he calls it, and a JD from George Washington Law School. James Brody, senior litigation partner of Garris Horn, he actively manages complex mortgage banking litigation and mitigation for its diverse clientele. He's practiced law for more than 20 years, primarily within mortgage banking. And during this time, James has successfully resolved hundreds of mitigation and litigation cases that involve complex mortgage fraud schemes, as well as large-scale repurchase and/or make-whole disputes. So James provides his clients with various services such as mortgage industry litigation, servicer and subservicer disputes, third-party fraud recovery, CPL and title policy actions, appraiser E&O claims, loan officer actions, regulatory compliance, administrative and business services, such as CFPB mock audits, JVs, LO comp, MSAs, and licensing, and last but not least, mergers and acquisitions. All right, I said I was gonna be short and sweet, but I could go on and on about these two gentlemen. Now we have a jam-packed agenda, so let's get to it. I'll turn it over to James and Scott to drop some knowledge about optimizing loan quality and navigating the next wave of buybacks, and hopefully, in true NSYNC fashion, say bye, bye, bye to those buybacks. All right, take it away, guys.
Get that in there, Michael.
Thanks, Mike. I'm not going to sing today, and we're all better off for it. But Mike and Sam and Melissa, thanks so much for inviting me. It's my honor to be here, not only to provide some information, but also to partner with James on this. So think of this webinar today in two parts. The part I'll be talking about today is how you can plan upfront, and how from a quality perspective you can have processes and procedures in place to hopefully prevent repurchase requests, prevent buybacks in the first place. Then we'll shift to James, and he will give some very helpful information about what might happen or what you can do if you should get one of those requests, or if you do have to buy back a loan, or how your contracts and other documents could hopefully put you in the position to navigate through that potential reality as successfully as possible. So with that, I think if we go to the next slide. Thank you. So here's the agenda, at least for part one this morning. There's a couple topics. How can quality control, how can your QC plan and function be used as a business intelligence tool to actually help grow your profits? We're going to talk about that. It doesn't just have to be a necessary thing you have to do to check a box. It can actually help your business be more successful. Then also, how important it is, especially right now in this market and economic environment, how crucial it is to create quality loans and hopefully not be in a situation where you're requested to buy back loans. Thirdly, before we turn it over to James, we'll touch on the big announcement from Fannie Mae about changes that will go into effect later this year, but that they encourage everyone to implement now for both pre-funding and post-closing quality control. And at the end, both James and I will hang. If there are any questions, you can type them into the chat if you have one. But with that, let's dive in to upfront. And so with that, we can go to the next slide. They say if you fail to plan, you plan to fail. And I think that's a big theme of these next few slides. How can you make sure you've planned ahead and have a good QC plan and function in place, again, to prevent the buybacks from happening? Another expression, cliche number two, is an ounce of prevention is better than a pound or equals a pound of cure. Well, what we're talking about this morning is imagine what a pound of prevention can do. So your QC process, where you have either internal staff or an outside vendor performing a quality review of your loans, again, is not just to check the box. It can actually provide your organization with a wealth of information. And that information, when you see what the issues are that are being found, can help you, for example, look for ways to automate a process, or maybe to add a checklist, or add a step to your procedures that will help every loan have better quality, right? Not just fixing the one issue with the one loan that someone reviewed and found a problem with, but how can you take that and look at all the other loans, most of which are not selected for QC review. If you think about a 10% sample that's reviewed, that's 90% of your loans that might get funded that are not reviewed by someone in QC. But if you use the results that you have, you can add operational efficiency, again, automation, that will help all of your loans be of higher quality, and so that you're hopefully not getting any buyback requests at all. Well, where else can you get information? Your QC review process is one helpful tool, but you also have, and I know these days it's a lot, regulatory and agency examinations, CFPB, states, maybe a Fannie Mae Mora, a core review from Freddie, and any other compliance audits you may be doing internally or through a vendor, and your consumer complaints. Hopefully you're not getting very many, but if you do, all of these things are sources of information that can help your company improve. Now, how do you do that? How can you use that information from wherever it may come to help your company improve? Well, the first step is doing that root cause analysis. And as Mike mentioned, I've worked at a lot of lenders before coming to MQMR, and I work with even more of them today. One of the things I hear over and over again is when there is an issue, if a loan either has poor quality, for example, a large deposit wasn't sourced, just as one example, or whatever the issue is, a common theme that I hear is, well, if we train that underwriter and tell him, her, them what the right thing to do is, then that problem will be fixed. And that may be true, but that may not be the reason for the issue. There may be something wrong with the system, or sourcing that deposit might not even be part of that person's process, or the company might be too busy, or that person might be too busy and they focused on other things. So if you don't get to the root cause of what's causing the issue, then the solution that will be put in place might not be the right one. And then the next time something comes around, people will be asking the question, why are we still having this issue? I thought we trained everyone. And the answer would be training wasn't the right step, or at least not the only step that was needed. So if you do the root cause analysis, then you can get to the appropriate corrective action to, again, not only prevent that issue, but help all of your loans. And then finally, you'll want to retest loans for that issue going forward to make sure that what you implemented is actually working as you expect, and that you're not having those issues repeat itself. And again, if you put all of that together, you get what I call the gold standard right in the middle of that slide. This information, your QC program, can help your company generate higher quality loans, but also more efficiently, more automated, so your cost to produce could be reduced at the same time as you're increasing your quality. The best of both worlds. Okay, if we go to the next slide. So we mentioned at the beginning, we all know what kind of a market we're in right now and what the economic environment is looking at. Well, at the same time as we're all struggling to make sure we can all do as many loans as we can, help borrowers stay afloat, the regulatory work doesn't stop. The GSEs, Fannie, Freddie, they're still looking. They're still doing more reviews, core reviews. They're looking at loans and looking at the quality of those loans as much or more than they ever have right now, including loan level reviews. And they are clearly, and James will get into this in his part, they're not hesitating to push loans back for repurchase. They wouldn't hesitate to even suspend lenders from being able to sell loans to them. All of these things can still happen in good markets and bad. So what's one way to try and think about how to avoid this? Well, let's go back to that point we talked about a little bit earlier, that even if you're auditing, for example, 10% of your loans every month, that's 90% of your loans that aren't getting reviewed, which makes it so crucial to learn from what you are finding. One of the things that I talk about with clients a lot is to look at the difference between your gross defects and your net defects. Because it's wonderful if at the end of the day, your net defects, your actual loans, for example, that shouldn't have funded, are very small or even zero. That's wonderful. But think about your gross defects. Those were loans where there was an issue or more than one issue, and maybe you were able to cure them. You got the documentation that you needed, or maybe you had it all along, but it didn't get into the file that was reviewed by QC. And so it didn't become a net defect. But again, the gross defects are just as important, because those are your loans. You'll see those issues in loans that aren't reviewed, not only by your QC department, but those loans might get requested for review by Fannie Mae or Freddie Mac, for example, and they're going to find those defects. And they may or may not be so lenient in giving you the chance to cure those, like your QC department might be doing. On top of which, your gross defects, again, lead to ways to have a better process, more operational efficiency, and to make sure, for example, all your underwriting documents are in the right folders in your LOS, so that if a loan file is requested, you're getting all the documentation that's needed for that review, so that you won't even have the gross defects. Because again, from a regulatory or agency perspective, if they find it, it might not go the same route as it does in the normal QC process, where if you provide the documentation, it doesn't become a net defect. So that's a really important point, And again, the more robust your QC program can be, and that can lead to training for your staff as a result of what's found, that can prevent having quality issues. And when I say quality issues, what do I mean? Well, let's take a look at the next slide. This slide has some examples from Fannie Mae themselves for issues that led to loans being unsaleable to them. I won't go over all of them. I will just use a couple as an example. Let's look first at the third one down. The category is excluded debt. And look what happened here. A $25 a month debt. Think about how small that number is. A $25 a month debt that was on the borrower's credit report was excluded from the underwriting for this loan without any documentation to support that exclusion. When you added in that just $25 a month, the DTI for that loan was pushed from 49, as you can see, 49.05% up to over 50%. And so that loan became out of tolerance with Fannie Mae's requirements. Think about how small that is, how minor of an issue we might think that is. But again, without that documentation to say why we're excluding this income, what were the mitigating factors, what was the reason, the loan became one that was out of tolerance. So, for example, look at the top one, missed liability. So this is one where it was just missed. And again, look at the amount. HOA dues, $25. Push the DTI, again, from just under 50% to just over 50%. And that took a loan that was within tolerance with Fannie's guidelines to now out of tolerance. It can be so small, especially in a market like this one, where there might be a lot of borrowers that are really close to the limits of what's allowed. What does that mean? That means you need to make sure that you're catching everything. And how do you do that? By having a robust process of reviewing loans so that you can find issues like this one. And this could lead to, for example, not only training for staff, but what can you have in terms of a checklist or automation that someone would have to sign off on? So again, that these issues can be prevented for all of your loans, not just found and corrected for the 10% or however many are being reviewed by your QC. So again, there's some really good examples here of how really small things can make a huge difference, or if it's found later, it gets into James's world and you're having to buy that loan back. So we can go to the next slide. Okay, so the third point, and we'll spend a bit of time on this, which is the Fannie Mae announcement related to quality control. So that announcement was their selling guide announcement 2023-02. The announcement came out on March 1st. So if you haven't had a chance to read through it, we highly suggest that you do, but we're going to go over the gist of it on both sides right now, pre-funding and post-closing. What were the changes that Fannie announced? Well, first, I put the quote in for the why. Whenever I talk with folks about something that's new or some requirement, I always like to make sure that we have an understanding of why this came about, why the change. Well, here's what Fannie Mae said. So straight from them, in an effort to improve overall loan quality and reduce the number of loans requiring remediation, we have enhanced both our pre-funding and post-closing quality control policies. So that's what they're looking for. Sounds obvious. They want better loan quality, fewer loans that are in this repurchase request in this buyback space. So let's talk about pre-funding QC reviews first. Well, here's what's new and very important. Lenders now must complete a minimum number of pre-funding quality control reviews every month. So that's what we know. So if you're not doing pre-funding QC today, you will have to start doing it. Now, what does that mean specifically? First of all, how many? It says you have to review a minimum number. What is that number? Well, the total number of loans that should be reviewed on the pre-funding QC side must be the lesser of the following. Either 10% of the number of loans closed by your company in the prior month, or 750 loans, whichever one is lower. So for example, if a lender closed 10,000 loans in the previous month, 10% of that would obviously be 1,000 loans, but a lender could choose to review only 750. Obviously, Fannie, if they were here, would say the more loans you review, the better, but it's whatever's less, the 10% or the 750 loans. And a lot of people ask questions about what about a statistically significant sample size? Well, the announcement says you can't use that unless that size equals at least the 10% amount or the 750. Now, that's the number. That's how many loans you need to review. There's a couple of other really important points on the pre-funding side. One is the announcement says that it's not just Fannie Mae loans that have to make up the 10%. It can be a combination of conventional and government loans that make up your sample. So you might be asking, why is that? Why wouldn't they want the whole 10% to be Fannie Mae loans? I think the reality goes back to that quote at the top. What they're looking for is that lenders are reviewing loans to make sure that you're making quality loans. And if you do that through a combination of conventional and government loans, then that will be sufficient for them. What they want to make sure is that you're doing it and on the pre-funding side. Secondly, this review can be a combination of what are called full file reviews or component reviews. And we've defined both of them for you here. So that full file review, of course, means the QC analyst will look at all aspects of the credit, the collateral, the whole loan. Whereas a component review will look at one particular element or aspect, and for example, self-employment income. Through a combination of both, you can get to that level that you need, and the results need to be in your QC reports. Finally, on the pre-funding side, we said what you need to be doing and how, but there's also the when. When will you need to start doing this? Well, the mandatory date for implementing the pre-funding QC reviews is September 1st, which means you'd have to start doing it in September, and the number would be based on the number of loans closed in the previous month, which of course would be August. So September would be the first month you have to do it. However, Fannie says that they encourage lenders to implement the changes immediately. Now, if you do that, you'll of course start getting the benefits even sooner. But the mandatory date is September for August loans. Okay, so if we go to the next slide, is post-closing. So on the post-closing side, the change they made is it's currently the case that for post-closing, the cycle to complete the reports and have the process finished is 120 days. Well, starting in September, that cycle goes down to 90 days. And so again, why? Why did Fannie change it? And so here's what Fannie said. The 90-day cycle allows for detection of errors closer to when the errors are generated. And so lenders, of course, can take action sooner and prevent more loans from originating with the same error. So there's no changes to the re-verification process. So you still have to do that as part of your cycle, which is now 90 days instead of 120. One thing that Fannie said, though, is they did eliminate the timeframes for the individual component pieces of the post-close QC process. So what does that mean? That means you could complete each part of your post-closing QC process whenever you like, as long as the entire process and that report is completed and sent off in that 90-day cycle. So again, when is this effective? September 1st. So starting for loans that closed in August. But they said the same thing. They encourage lenders to implement it immediately. Okay, we're almost done. Let's go to the next slide, which is what do these changes mean for your organization? So for pre-funding, you can start by asking, what is your process today, right? How will you in this environment add this process if you need to in terms of either number of loans or doing it at all to meet these requirements? And how will you handle the process of fixing the issues that you'll inevitably find pre-funding, right? How will you work with your underwriters, work with the borrower, the loan officer, or brokers if you're wholesale? How can you make sure that you're getting your monthly reports done and providing feedback? So one way is to make sure you have a strong process. If you use a vendor, They can help you with that process. But if you do use a vendor, you want to make sure that you vetted them thoroughly, that they're qualified. And secondly, that you have strong oversight over your QC vendor, including a check to checker. What does the check to checker mean? It means you'll want to review a percentage of the loans that your QC vendor reviews to make sure that they're finding all the issues that they need to be finding. So if they're not, if you find things that they didn't, that you're giving them that feedback. So with that, we can go to the next slide, which I think is the last one. On the post-closing side, how can you do a cycle in 90 days that people are struggling to do today in 120? Well, I think the answer is the same. You want to have a very well-defined process. So again, if you're using a vendor, you want to get them the list of loans that closed the previous month on the first day of the month, if you can. So they can start selecting the sample, start reviewing the loans. It can help you be as close to the front of the line as possible with your vendor. Then with your internal staff, you want to make sure that they know if there are issues, they have to respond to them urgently. What does that mean? It means if you're an underwriter at your organization, doing this QC process, including responding to findings, should be part of their job duties. And that should be carved in. Their manager should know that this is part of their job and they need to do this every month. And again, the more well-trained your staff is and the better your process is, the fewer issues you'll have each month. So if we look at the next slide. That's it for me. So I'm going to turn it over to James, who will take it from here. In the event that despite all your planning, there is an issue, James is going to tell us what to do from there. Take it away, James.
All right. Thank you very much, Scott and Mike and Samantha. I really appreciate the opportunity to be here today with everybody. Right at the outset, we just give the, courtesy notice with regard to legal advice. But that being said, please go to the next slide, please. So, with talk about the pre-funding, the quality control, when it gets to my desk, most of the time, these loans are already old. I mean, at present, we're dealing with some litigation that had come from Washington Mutual through the FDIC. We're dealing with loans that are 15 years old. Other times we deal with loans that are very current, which either the investor or the agency won't take for one reason or another. But at the end of the day, most of the time, the loans that are going to be repurchased or indemnified, they already have the problems. They're already done. And the best thing that you can do is look at how best to avoid them in the future and how to deal with the ones that you have right now. So for today's agenda, we're going to start just very briefly with regard to the current repurchase trends, avoiding repurchase demands, how to prepare for those demands, how to defend against those demands, then mitigate when you can't do so, and then some general tips on how to settle the claims that are coming from the aggregators and or the agencies. Next slide, please. So right around the time of the meltdown, most of the loans at issue that we were seeing come out were based on product issues. I mean, I would say 95% of the demands had to do with stated income, stated document type loans, also known as liar loans. I remember one of the first cases that we were litigating. We had litigated a number of cases in Missouri with City Mortgage. We just couldn't understand how an investor knew in advance what was going to happen or projected what was going to happen with this product, and then went ahead and once they went ahead and bought them, and they went bad as they were expecting, that they could just go back to the seller and ask for the money. But at the end of the day, it really comes down to the language that you have in your loan purchase agreements as well as your seller's guides, which we'll talk about here shortly. Now, with regard to the demands that we're seeing right now, there's a larger focus on those underwriting issues. So definitely quality is a very important issue. We're seeing more processing errors, compliance-related issues in transferring loans, such as lapses in hazard insurance, as well as, fraud. I mean, there's always going to be fraud. Anytime there's a market that's going up, loans are going faster and faster, there's going to be more and more fraud. As far as the counterparties that we're seeing, again, I mentioned City Mortgage. We did a lot of litigation against ResCap RFC, Bank of America, the FDIC through IndyMac, and I think I had handled about 70 cases when it came to Lehman. What we're seeing right now is much more from Wells Fargo, and that makes sense. Like City Mortgage, Wells Fargo is now getting out of correspondent. So really, they don't have much to worry about with regard to the relationship. They want to clean up their books. And that's, of course, my opinion of it. And we're also seeing claims from the FDIC on Washington Mutual on loans that were brokered through Long Beach. We're seeing them come from AmeriHome, Penny, as well as, of course, the agencies. Timing, anytime you're in that down cycle when things are tough, when there's not a lot of money, they're going to be more litigious. They're going to issue more and more demands, but also the agencies are now catching up from the backlog they had during the pandemic. Next slide, please. So how to avoid these claims? Well, number one, diversification. We always recommend that you don't put all your eggs in one basket. If you're selling 80% of your volume to one investor, let's say, and then you have a problem with that one investor, you're going to be in big trouble. So the first thing you want to do is make sure that you have a good investor deck, that you're diversifying. If you ever have one problem with an investor, that you have others that you can go ahead and sell to. Contract negotiations. It is amazing how many of our clients and how many lenders in the industry in general don't try to negotiate their mortgage loan purchase agreements or their seller's guides or their broker's agreements or many other contracts that utilize on a day-to-day basis. And many people think, hey, we're a small shop, we're dealing with a big player, they're just not going to give us many changes here. Well, at the end of the day, even for the smaller players, let's say we've asked for 40 different changes to an MLPA and seller's guide. At the end of the day, if we get 3 or 5 of those, that's going to make your contract better overall, so that if and when you get in trouble, you're going to have some, different leverage points to try to resolve this without litigation, without hindering your business. So, anytime you're up for a renewal, anytime you're up for a new relationship, or anytime that you think there's some issues that need to be addressed with a partner, such as an investor, you should go ahead and take a look over your correspondent agreement, your seller's guide, see what things you can do to improve that, give yourself a fighting chance down the road. Again, many investors, and we've dealt with many of them in negotiations and seen what they will do, what they won't do. But, for instance, there are some investors out there that may say, look, you agree to waive all your legal defenses. It's not many of them, but we've seen it. And in that case, we would tell our client, look, that should be a deal breaker, a no start. If you're going to be in a relationship with anyone, it should be a fair arrangement. It should have both parties having, equal obligations in some regard, at least to a matter of fairness. But to say that you waive all your legal defenses, regardless if it was your fault or not, that would be problematic. Another thing that you should think about is when you have the seller's guides, which change all the time, they're voluminous, they're posted, you're not going to be reading through those day in and day out. So when you are negotiating your MLPA, it's important that you go ahead and say, if there is a conflict between the mortgage loan purchase agreement and the seller's guide, that the MLPA will govern and that the changes to the seller's guide won't impact you to the extent they conflict. That's just a couple of the changes that I would recommend, as well as putting a lot of materiality throughout the agreement to make sure that you're not getting nitpicked and have to buy back a huge loan for an issue that at the end of the day should have been able to be resolved. Next slide, please. All right, so avoiding the repurchase demands. Again, when you're negotiating those contract terms, the indemnification provision, which is the biggest source of your future liability, it's frequently litigated by us and is definitely something that you need to pay close attention to. The repurchase provision, you should obtain a provision that allows for notice and opportunity to cure, and as well as any of the notices that are in your agreements. If it says 5 days, if it says 10 days, why don't you ask for 20 days, 30 days? Give yourself a little bit of time. Things don't move very fast. You need time to investigate. You need time to do an adequate response. And so, make sure that you're adding time in there to give yourself some breathing room. Now, what about issues subject to repurchase? Well, EPDs, they may be subject to a repurchase or only a fee. Obviously, a fee would be the best case. And then as far as sole and exclusive discretion language that they put in there, that's something that you definitely want to change. There should be a reasonability or a reasonableness provision, not sole and exclusive discretion, because at the end of the day, that gives them, sort of carte blanche to go ahead and make some decisions that may not be in your best interest. Offset net funding, again, obtain notice, ability to cure or cap, anything that you can do to make your contracts better is going to be in your best interest and could save you a ton of money. Miscellaneous terms, unilateral ability to update, supplement their guides. Again, proper notification, because otherwise, these changes happen. You don't know about them. You're not taking them into consideration, and it will affect you down the road. Many of the correspondent agreements have unilateral attorney's fees provision. And what that basically means is that if you get sued, such as when Lehman was filing suits, against many people, if they were to win, they would get not only the damages, but they would also get their attorney's fees. Well, if the lender won, they would be able to walk away having spent a lot of money to defend themselves, and they would not be able to recover their attorney's fees. Now, some states, will read unilateral attorney's fees as being reciprocal, but states like New York and certain others will enforce unilateral attorney's fees. If an investor knows that they could get dinged for the attorney's fees if they lose a case, well, it's more likely that they won't bring a case or that they'll try to resolve it with you first. So that's a big issue. We already talked about the conflict between the MLPAs and guides, materiality qualifiers, and never waive your right to exercise your legal defenses. Again, a deal killer. Next slide, please. All right. So what about other things besides the contracts? Well, again, make certain that your underwriting staff, they're fully trained, especially for some of those more complex loan products and situations. Make sure that all investor and program requirements are being met. This is more common sense. And alternatively, consider outsourcing your underwriting to a third party that has the financial ability to cover any potential errors. And when I gave this session not too long ago, and I asked, for anyone that's outsourcing, whether they were checking to make sure that the outsourced party has errors and omissions coverage. So if they screw up, you have the ability to go after them and get some possible insurance money. They kind of shook their head, didn't know. So, anytime you're looking at your various vendors, you should be making sure that they have proper insurance coverage in place to give you additional sources of recovery. Next slide, please. Okay, preparing for the repurchase demands, the increased importance of reserves. There's no, magic scientific number of what, amount you should keep in reserves. But, given the uncertainty, you should have sufficient reserves to cover your likely exposure. Different factors to take into account are, going through and doing a comprehensive risk assessment, looking closely at the problem loans that you've had, determine the average repurchase losses that you've had historically, especially during the downtime, and then err on the side of being conservative to mitigate your risk. There's also the issue of reps and warrants insurance. One of the things that I did when I first got my start in the mortgage banking industry was represent insurance carriers who were receiving claims for reps and warrants or repurchase type issues, defending them, and then going after the third parties. There are a couple of them. Anytime you are considering whether and which repurchase insurance you should get, if you do get that, and if it makes sense, you should find out what, the number of claims they've had in the last couple of years. You should find out their claims payment history and make sure that they're going to do a good job if push ever came to shove and not just collect premiums. Next slide, please. All right, defending against the repurchase demand. So anytime you get one of these demands, you should always start by looking at your business relationship. If you are asked to pay $20,000 and you are selling, tens of millions of dollars to the investor, well, at the end of the day, you're not going to want to cut off your nose to spite your face. Always take into consideration your business relationships. If you have some good relationships that are internal, reach out to the people that you have the relationship with. It can never hurt to have a friendly voice on the other side for you. If it's an important relationship and you need to get lawyered up, you don't know what to do. Well, a lot of times when we get in that type of situation as a law firm, we will ghostwrite the defenses for our clients so that they can go ahead, not get lawyers involved on their side as well as on the other side. Of course, when you do that and the lawyer prepares the rebuttal for you, if you want to make sure it comes, or it looks like it comes from a business person, you need to make sure that you add your own tone. No matter how much a lawyer tries to write like a non-lawyer, it's never 100%. It's just ingrained in us. We're going to say legalese words, and it's going to look like it came from a lawyer, which is what you want to avoid in those situations where you have a good relationship. Evaluate the nature and extent of the damage that's being claimed, the strength of your defenses, and the fees and costs. Again, let's say you don't have a good relationship with the investor. Maybe you're not even doing business with them anymore, but they come after you for something like $20,000. Well, you're easily going to spend a ton of money on a lawyer to do that. And if you end up getting sued, that $20,000 could, be compounded where you're going to spend a lot more. So, at the end of the day, even if you were to win, you may spend more than $20,000. You can waste a lot of your time. So, again, just to have some common sense. If you're looking at 100,000, a million, 10 million of damages, well, then it's a much different story. Then you go ahead, you roll up your sleeves, you lawyer up, and you do what you got to do to defend yourself, because that's a ton of money. And it could be a very bad result if you don't take those steps to defend yourself. Request all the information that you need in order to evaluate the claims. Get a copy of the loan file, get a copy of the servicing notes, take a look at the seller's guide at the time of origination that was in place, because again, these things change all the time. So you need to know what standard was being used at the time you originated that loan. Now, a lot of investors will say, hey, look, this is private information. We know you sold us the loan, but, we have a duty to protect the privacy. We know that we want you to buy it back, but until that time, you can't take a look at this information. That's a bunch of nonsense. When you look at the Gramm-Leach-Bliley Act, you look at the exceptions, you look at the fact that you already knew this information, that is one of these shields that certain investors try to use to not give you the ability to make a proper defense. You should insist that you get that information, especially when it's relevant to the demands that are being made. Insofar as, having a third party, I recommend, and while I'm a lawyer and I benefit from this, the whole point is that, let's say you have an appraisal issue and you want to go out and order a retrospective review appraisal to see what the issues were or were not. Well, let's say you go ahead and you order that and it comes back really bad for you. Okay, you now end up in litigation. Well, you're going to have a duty to provide that very bad retrospective review appraisal to the opposing party. Whereas if you have your lawyer order it, it could give you an additional insulation from the privileges to not produce that. Of course, if it's a good result, then you go ahead and produce it. But if it's bad, you want the ability to not have to produce that. It's in your best interest. Next slide, please. So mitigating repurchase exposure. Look, on the one hand, you try to prevent them, you try to rebut them, and to the extent you can't do either of those, and you find out, look, there was a really bad thing that happened. There was someone flipped, someone chunked, someone, there was an air loan, whatever, bad thing you can think of about misrepresentations, omissions, it happened. You have to deal with it. Okay, well, now you need to look at identifying the responsible parties for that. Was it an appraiser, broker, borrower, settlement agent, title company, and understand the applicable statute of limitations for each of those parties. And that should be the first thing that your lawyers do when they receive these demands. So in many instances, that's why you want to make sure that your broker agreements are very tight. If I'm a lender and I'm negotiating the MLPA with the investor, I want it as favorable to me as possible. But if I'm negotiating a broker agreement on behalf of a lender, I want it to be more akin to what the investor sent me. I want them to waive, maybe not waive their defenses, because that's a really bad option. And it just doesn't leave a good taste in anyone's mouth. But you want to make sure that you have good, strong, tight language in there that's going to give you a leg up if you need to go after and put your hand in their pocket to pay for the problems that they caused. With regards to borrowers, usually don't get them to cough up a lot of money. Maybe there's a chance at a refi, maybe not now, or a sale for a payment in full that gets rid of the deal. Great, but usually that doesn't happen, especially in a market like this. So borrowers are a good source of information that you can use to go after the other parties. Settlement agents, they are called the gatekeepers of fraud. And the title companies, do you have a title claim? Do they offer a closing protection letter, which offers an additional layer of insurance in case the settlement agent fails to follow your closing instructions with regard to your documents or monies? And when you're looking at those CPLs, you need to be very careful with what the statutory language is in there, in the states where they're offered, because some days you have to, in some of those CPLs, you have to give notice within, say, 30 to 90 days of the date of discovery of loss. Some say promptly, which lawyers love promptly, because prompt to one person is not prompt to another person. It's something you can argue, or 1 year. So at the end of the day, don't underestimate the power of a closing protection letter to be able to give you a leg up in your pursuit of the title company when the settlement agent runs afoul. And in order to trigger that, what you want to do is look over your closing instructions. Maybe saying that if the settlement agent knows about a change of hands of the property or dealt with the buyer within the prior 90 days, something like that, that they have to give you written notice and confirmation or approval prior to closing. And if they fail to do that and there's a proper closing protection letter, again, you have insurance there through the title company, which is normally offered incidental to the title policy. So again, you want to take a look at those third parties. You want to make sure that you're taking steps to improve your ability to go after them if and when you need to. Now, what about the second point here? Well, you need to confirm that the third party is still in existence. Do they have any money? Are they worth pursuing? Maybe you have a great claim, but maybe they're bankrupt, or maybe they're, disappeared. You don't want to spend a lot of money on that. So, now fraud and things like that, it may not be a dischargeable event in a bankruptcy proceeding, but at the end of the day, I mean, if you're getting $20 a month for 10 years on $1 million loss, it's going to be more of a pain in the backside than it's worth, at least in my estimation. Identify and gather the relevant documents. Again, take a look at the audit report, the CPL policy, repurchase demands, calculate the damages. One of the things you should also look at, let's say it's a loan that's REO. Some states have this provision in there, talks about the full credit bid rule. And what that basically means is that when you bid on the collateral at a foreclosure sale, that some states will take that value and make it that is the presumed value. So that if they bid the full amount of the debt, or they bid less than that, that they may be limited or capped by whatever they bid at the foreclosure sale. So that's another thing to think about, if and when you get stuck with one of these demands. Make sure you speak with your insurance broker or legal counsel to advise. Now, a lot of times you're not going to have the ability to go ahead and get insurance, outside of reps and warrants insurance policies. But I can tell you, in those cases where we've represented tens of lenders in big matters, maybe there was a couple that had a policy where the carrier agreed to pay for the cost of defense. That's going to save you a heck of a lot of money. Most of the time, even when the carriers do it under a reservation of rights, at the end of the day, they just want to wash their hands of it. They don't want to face a possible bad faith claim, which would subject them to treble or triple damages for their failure to adhere to their coverage obligations. And so they're usually, even if there's a very slight basis for a claim, they'll usually just go ahead and drop that, walk a separate way, and even put in money towards a settlement. Next slide, please. Settlement tips. Investors often have the option of providing you with indem instead of repurchase. If a loan is current, it's much more likely that they'll do that. Maybe you agree to a 6 or 12 or 18 month indemnification in lieu of repurchase, where if they stay current, they withdraw the demand and the deal is done. Sometimes not. Now, one of the things also that you can look at, and I think this might be mentioned a little bit later, but, a lot of the settlements that we had done when there was good production being done, and this was after 2008, is to have a sort of a bit clip arrangement, meaning that you say, hey, investor, I want to resolve this deal. I want to pay you the money, but how about this? Rather than, stretching me thin at a time when, I need this cash, we'll sell you a certain amount of volume and you take your settlement monies or the resolution monies out of production. So that it doesn't come out of our back pocket. You get assured production. And that's one way to, deal with that issue. Now, due to the high cost of litigation, investors are sometimes more willing to negotiate once litigation has commenced. So if someone comes after you and says, hey, look, I've got a $5 million claim, and you look at it and you say, gosh, that's a really horrible one. We'll settle for what we believe is going to be the cost of litigation. And the investor tells you to pound sand. Well, when you get into litigation, you can be assured that the investor is going to be more likely to settle that. It may take a while, but at the end of the day, they may be and usually are more willing to make compromises in litigation when they're being forced to have things like settlement conferences, mediations, and what have you. Challenge the losses. A lot of times an investor will, whether it's a fire sale or whether they, take proper steps to try to mitigate, they rely so heavily on these, MLPAs and sellers guides that it's very, very important that you go ahead and push back on them. Nothing ventured, nothing gained. One of the things that we're also seeing is that, and this kind of goes back to the beginning about negotiating these agreements. A lot of times we're seeing that you underwrite, say, to Fannie, and they end up going ahead and placing it somewhere else. You didn't go ahead and underwrite it to the other, and then they say, hey, look, you were supposed to comply with any and every, thing out there, and if you didn't, then you have a duty to buy this back. So you should be looking at issues like that when you are negotiating with those investors. Also, you want to make sure, and I know that there's certain people out there, Taylor Stork and otherwise, who have been looking at, working with the agencies in order to try and find some sort of tri-party agreement. Because look, when an investor gets a demand from the agency, they don't want to disturb their relationship with agencies. The agencies are very important to everybody. So they may, not fight as hard as they should. Maybe they have a good basis to do that, but they're not willing to push back. So, you also need to go ahead and since it's your money on the line, you need to make sure you're taking a good look, or your attorney's taking a good look over this and giving you some really great advice. Let's see, as far as the global settlement agreements, one thing that happens is if you've got two loans, two demands, you want to go ahead and get those settled. They're not going to go ahead and say, the investor's not going to say, okay, well, you pay us for these two and we'll release you from any and all liability on any loans that you may have originated and sold us. It's not in their interest. Now, if they have 10, 15, maybe, and you're not doing business with them, they may be more willing to do that. But the trick here to, root out whether there's additional problems and give yourself the best chance of walking away with a settlement that's going to give you some peace is to say, okay, we're going to settle these 5 loans. You're not willing to do a universal settlement, but in the settlement agreement, you have to rep and warrant that you are not actually or constructively aware of any other loans out there that have problems that could come back to us. So that if they were being reviewed and they've noted a problem and they failed to bring that to your attention prior to the settlement being finalized, then you have the ability to say, look, you made a representation that there wasn't anything out there. I relied on that representation. So, you can pound sand. I mean, obviously say it in a much more tactful way, but that's the long and the short of it. I could go through this for quite some time, but the time is limited. I think between, the excellent presentation that Scott gave regarding loan quality, as well as these additional tips with regard to how to deal with these demands on matters that may already have problems or that you may suffer in the future. By all means, I think you have a pretty good roadmap here, and I think the CMBA was very good in putting this presentation on. So thank you.
Wow, that was awesome. I think we'll open it up for questions. Sam, do we have any questions?
We haven't had any that have come in yet, but just, as a quick reminder, there is a Q&A dialog box. So if you have any questions for James or Scott, please feel free to send those in.
So I have a question for you, Scott. how often do you see lenders really dig into all defects, not just material defects?
Oh, that's a good question, Mike. So first of all, I'd say even on the material defect side, if it's an issue that came up as a gross defect, but it was able to be cured, so it didn't become a net defect, for a lot of companies I talk to, that sort of stops the inquiry right there, even for material ones. For moderate and low risk defects, I would say that generally there's not a lot of digging into those defects. And what I would suggest to folks is A, that's still valuable information, and B, a moderate defect, if left unchecked and untrained on or unresolved, could absolutely turn into something that could become material depending on what that is. So again, there's two reasons, Mike, why it's such a good question to think about your moderate and even your low risk defects. Number one, to make sure they don't get bigger or more widespread. And then number two, it's information that can help your company operate more effectively if you fix it.
And every time you touch a moderate or low defect rate, it costs you human labor to go through that process to clear it.
Sure does.
James, question I thought about at the very end. You shared a lot of great tips about negotiating MLPAs that I think a lot of lenders would be running back to dust them off and relook at them after this presentation. So if they look at their MLPA and they find that the language isn't strong enough, a lot of the tips you talked about, like, man, that's really good. I don't think a lot of lenders think about that when negotiating up front. But how would you recommend that they go back to their current correspondent investors and try to renegotiate some of the language that you suggested today?
Well, the great thing about contracts is they're made to be broken, but broken in a way that's going to be the right way. So, I mean, you can always renegotiate, whether you're in a job, you want a better salary, if you're, whatever the case is, you want something. You have a basis to ask for it. There's nothing you can do about the past loans that were already produced, but, there's nothing stopping you from stopping the business. Walking away, diversifying your portfolio to somewhere else. So if they are interested in maintaining you as a customer and a seller, then they should be willing to make some accommodations on your agreements.
And do you take the approach where you ask for everything and redline it as much as you can and come to a happy medium, or do you try to be kind of understanding of the other side?
Yeah, I mean, whether it's an MLPA, whether we're negotiating LOS agreements, whatever we do, we go ahead. We start off with, a full red line. Normally what happens is that gets sent over to the investor or the vendor. They have their counsel look at it, come up with some additional counter red lines. We set up a call with our clients as well as the business and legal on the other side. Normally it comes down to, hey, there's no way we're going to do that. Hey, we can do this. Or, hey, we can meet somewhere in the middle. Let's send you some proposed language. Usually they'll send back another copy after that, or we'll send back another copy. We'll hop on the phone again. And then it's that process. It usually happens about over 2 or 3 times, and you should have a final product.
Awesome. Sam, did we get any other questions?
No other questions right now, nope.
All right. Well, I am available for hire if anybody wants me to sing "Bye Bye Bye" and sing. Mortgage compliance, yes. Blessed with singing capabilities, no. I'm sure I'm not going to get a lot of inquiries, but just wanted to thank both of you for putting on a great presentation. I mean, tons of information, tons of tips, and a lot of practical takeaways. Thanks again for joining us today, and stay tuned for the next few months of webinars. We have topics such as HMDA, cybersecurity, QC, and more pretty much every month through the end of the year or through October, and we are looking for a sponsorship. So if you want to get in front of your target audience, QC companies, compliance companies, law firms, providers, we are happy to take you on as a sponsor. Sam, anything else?
That's it. And just like you said before, Michael, this webinar will be recorded, or has been recorded, and will be available on our MQAC committee page on cmba.com to refer back to. It should be ready here in the next, by tomorrow.
All right. Thanks, everybody. Have a great day.
Thanks, everyone.
Hey, thank you.
Have a good day.
All right.